Hello, and welcome to this latest Lunar Quarterly Update. Today, we're going to be focused on the 2024 outlook. My name is Alex Brandreth, Chief Investment Officer at Lunar. Firstly, before we go into the presentation, just wanted to take this time to wish everyone a Happy New Year. Now, I'm going to share my screen and we can go through some slides. So the objective today is to give a bit of an outlook, as I said, on 2024. We'll touch on economic growth in the UK and globally. We'll obviously talk about inflation. It's a topic that we can't get away from and is going to be important this year, just like it was in 2022 and 2023. We'll touch on what that means for interest rates. Inflation has been falling quickly and there's now some chatter that interest rates might be heading down. We'll also talk about our outlook for different asset classes. So firstly, just wanted to give a little bit of an update in terms of what's going on with the UK economy. Now, this chart goes back a year, so back to November 22 and up to date of November 2023, which is the latest information we have. This is monthly data, so it shows how the economy's been performing on a monthly basis. And as you can see, it's been a bit of a mixed picture. It seems that monthly is all over the place. And sometimes the economy is contracting, other times they're expanding. And it's basically meant that during 2023, the UK economy grew by a fraction. You can see the different components to what drives GDP growth within the economy in the different coloured bars. So services in the light blue, construction in the green, and production, which is that dark blue colour. What dominates the economy and economic growth is services. We are a service-based economy, so that's important to remember when thinking about where we're going forward. What about the global economy then? So the global economy, as you can see here, is performing significantly better than the UK. As I said, the UK economy grew only slightly in 2023, and it's forecast, this is by economists, but by the Bank of England, the IMF, the World Bank, that the economy will only slightly grow again this year. Slightly better growth in the Eurozone, but that has to be broken down because Germany is really struggling at the moment, and it's on the teetering with a recession. Japan, US, and China, as you can see, are growing slightly better, but all of the purple bars are below the grey bars. So economic growth this year is forecast to be lower than it was last year. And that's important because that's going to drive investor confidence and investor sentiment. Economic real GDP growth data is always introduced with a bit of a lag. So we've just shown that the latest data we have on a previous slide for the UK economy was November. But there are indices out there which give you a better guide to what's going on with the economy right now. And on the right-hand side of this chart, you can see composite purchaser manager indices. That gives you a real good guide of what's going on with the economy right now. And as you can see, the UK has bounced back quite strongly right towards the end of that chart. This chart just goes from 2010. But Europe is struggling. Europe is very much teetering with recession, and particularly Germany because of the weaker data coming out of China and their COVID recovery. The US has been pretty resilient, and in 2023 from a growth perspective, and you can see there that their grey line is still above that 50, which means the economy is still in expansion. So as we look forward to this year, you start it with economic growth looking like it's improving in the US and UK, struggling in Europe, but it's going to be a year of weaker economic growth. One of the positive news, though, is we're now in a situation where inflation's falling. Inflation has been falling quite significantly, and it's been doing so at a similar rate to what it went up. So this is a positive development. This has been what's kept economic growth in the UK very subdued last year because everyone was worried about the cost of living crisis. And importantly as well, this chart shows the different components that make up inflation. You've got services in blue, core goods in green, food, alcohol, and tobacco in that purple colour, grey is electricity and gas, and liquid fuels is the kind of lime colour. And the orange line is put them all together, what do you get? And as you can see towards the end of this chart, a lot of deflationary forces were coming through. Electricity and gas and liquid fuels are now deflationary. And that's because the energy prices that we're paying this winter weren't the same as they were a year ago. So that's deflationary. Not only that, though, the other components are all now starting to reduce in value. You can see core services coming down and food and alcohol and tobacco is starting to come down as well. Economists are very good at telling you what has happened, but what's more important is what's going to happen. And on this chart, this is from Lazarus Economics, and they look at what their inflation forecasts are. They look at the price of goods a year ago on different months and then forecast what they think it's going to be in a year's time. And that gives you a guide to what inflation can be. And as you can see here, in April, May, and June of this year, they're expecting inflation in the UK to get back to the Bank of England's 2% target, which is crucial. That will give the Bank of England some breathing room to potentially reduce interest rates. And if you look at the average column, we're moving back to 2.6, which is very much in line with where we've been in the past, similar to 2017, 2018, and 2021. So inflation, hopefully, is yesterday's story. As I mentioned, that means that we are now, in our opinion, at peak interest rates. Interest rates have peaked at 5.25%. They've been held by the Bank of England for the last 3 meetings, and it's likely in the summer when these inflationary figures start to come through that the bank will look to cut interest rates. That will be a positive for the UK economy. That will be a positive for mortgage rates. In fact, mortgage rates have already started to come down because that's starting to be viewed as a likely event by the market. 2024 is going to be a very busy year in politics. We clearly have our own UK general election, which will probably be held in the autumn. You've then got the US election coming through. But apart from what's going on in the UK and US, there's a lot of global votes coming through this year. You've already seen Taiwan go to the polls. You've got India going to the polls as well. So it's going to be a real big year, which could cause some volatility in markets. I should say, though, that should be short-term volatility. Over the long term, politics really doesn't have too much of an impact on the economy or stock markets. And this chart really highlights this. It goes all the way back to 1947. You've got red bars for Republican government, you've got blue bars for Democrat government, and you've got a divided government in those grey bars there. At the top, you can see what that means for the economy. Is the economy expanding or contracting under the various different governments? And on the bottom, well, what does that mean for stock markets and the S&P 500, the US stock market? As you can see from this chart, you have positive years from an economic growth perspective for both parties. You have contractions, you have recessions for both parties as well. The stock market has positive and negative returns for both parties and a divided government. So really, politics historically has not been a key driver to the market. Let's bring this back to our current views. So this is one of our favorite charts, and we've been showing this in previous quarterly presentations because it really highlights the returns on offer within the fixed income market, the bond market at the moment. On the left-hand side, you can see different government bonds around the world, Japan through to the UK and US. You've then got in those grey bars, investment grade bonds. They're corporate bonds. So you're lending money to corporates. You've then got convertible bonds, which convert into equity. High yield bonds, again, they're corporate bonds, but they're slightly higher risk because they're in smaller corporates. And you can see the high yield bonds yield is higher than the investment grade bond yield. And that's because you're taking more risk, you should be getting higher return. And then you've got emerging market bonds on the right-hand side from different countries and different corporates and sovereigns. The diamond in each of these represents the yield at the start of 2022. So if we look at the UK's case here, you can see that the yield at the start of 2022 for a UK 10-year government bond was around 1%. Today, that's a lot closer to 4% because interest rates have adjusted higher. And you can see from this chart that the bars are all higher than the diamonds. In the majority of cases, there's one exception. And that means that the return available from fixed income assets going forward is going to be a lot more attractive. And during 2023, we at Luna really increased our exposure to bonds because they're a lot more attractive. When I started in the industry in 2005, we had high yields on fixed income asset classes. But with interest rates being kept so low for such a long period of time, the return on these assets were also low, and we therefore had quite a low allocation to them. But today, as I say, we're getting rewarded for holding these assets, and they do offer good diversification within portfolios. What about the equity market? So let's just explain this chart as well. So the grey bars represent the range of valuations on PE ratio, price to earnings ratio. The grey line represents the average, and then the blue diamond represents where we are today. If you have a low P ratio, that means companies are cheap. So down here at 10 times means it's quite cheap. Up here at 30, 35 times means that the market, as an aggregate, these are just global stock markets, are quite expensive. So what we're looking for is looking to take advantage of opportunities and buy cheaper companies. So that's really coming through from the UK at the moment. Europe's looking around average. The US is trading a little bit more expensive compared to its average, but it's not up at the high levels that it has been in the past. And emerging markets in China have had a really torrid time. It's not been a good place to be invested over the last 3 years. Just wanted to say thank you for your time today. We hope that's useful. If you do have any questions following on from this, please feel free to contact your Luna representative and we'll be in touch. Wishing you all the best for 2024.